most beginners and even experienced investors spend hours looking at confusing financial statements. Today I'm going to show you how I analyze any stock in under 5 minutes using the system I spent 8 years building. I used to spend hours doing research, but now I can compile all the information I need in seconds. I built this because I needed it. In the next 5 minutes, I am going to show you how to instantly pull the fundamentals of a company. I'm going to walk you through the exact 18 metrics I use so you understand exactly why this system works, and we will value the company based on our own assumptions, even considering stock-based compensation as a real expense, which most analysts and investors miss. Today, we'll be analyzing Google stock. You might wonder why, and that's a good question. We choose Google because it is a company that we have been following in this channel. It is a company that we have already done our due diligence, and it is a company that we understand. So basically, it's on our circle of companies. And in the last year, they've been outperforming their peers, especially their Mag 7 peers. So right now, the question is Google already overvalued, or there are still value to buy in this company? So let's start. We enter the ticker Google, so we wait a few seconds and instantly we get the fundamentals like forward PE, forward earnings yield, free cash flow yield, margins, balance sheet. Then we get the visuals like revenue, net income, free cash flow, stock-based compensation, revenue growth, net income and free cash flow per share metrics, margins, growth, net income and free cash flow margins, shares outstanding, return on invested capital, all of that to help you see all the fundamentals of the company have been evolving. Then we basically assess our quality scorecard. It's 18 points. It's basically a checklist that we'll like to evaluate in every company. So we'll do this really fast for Google. Revenue growth, check mark. Market potential, they will be growing in the next few months. It's a check mark. Plenty of growth ahead. Quality of their revenues. Most of their revenues are pretty recurring, could be high quality, but most of them are consumer based. So I'll say it's a medium. In terms of process and in product development and research and development, better than average company. They invest a lot in new products. Great gross margin and profit margins. They have been maintaining their profit margins. If you look at that, net margins are actually increasing, but some of that it's because it's inflated by investment in other companies like Anthropic and SpaceX, for example, and these gains are appearing in net income. So, and free cash flow margins going down because of heavy capex investment, but basically they are maintaining their margins. I believe when compared to competition, they have better margins than their competition. They have plenty of pricing power, Google, so they have one of the best business, so you will use that, especially in the advertised business, and now with AI, I believe pricing power is not a problem for Google. In terms of debt structure, their balance sheet is incredible, they have more cash than that, so it is a better position. Rates of return actually very high, above 30%. Management extraordinary, cultural reputation extraordinary for me. This is based in my opinion and my due diligence that I have done in this company. What is this moat? I believe it's wide. It's not an impenetrable or a monopolistic company. It's based on network effects. Basically, it's their biggest moat. In terms, it could be enduring, widening. I believe it's increasing, it's widening. They are using AI in every product, so I believe, in my opinion, for Google, it's getting better, their moat. They've been growing free cash flow per share, and they've been returning capital to the shareholders. With this 18 checklist scorecard, we came with the quality score of 90.8, one of the best companies in the market. So, in terms of valuations, let's look into that. So, stock-based compensation, they have increased their stock-based compensation, but as the company grows and gets more mature, I believe the stock-based compensation will get lower. For now, they have been growing at 8% average. Last year, 4.9%. So I believe they can grow. Their stock-based compensation will grow around 3% in the next few years. So it is a West company in terms of business risk. it is not safe because AI, there are technology landscape is evolving, so it's not safe. I'll say it's low. If you say it's medium risk because of AI, I will not disagree, but my assumption it is a low risk because of that. That's a good balance sheet and a good business mode. So what will be the growth rate for Google? In the past years, having grown around 10%, they are expected to grow 24% next year and 18%. AI will increase their growth rate. So for the next 7 years, I'm expecting them to grow around 13% per year. In terms of free cash flow margin or net income margin for the future, will go. Their margins have been increasing 2024, 28.6%, 32% 2025. Now it's around 38%, but this is very inflated. I believe in best case, Google could achieve free cash flow margin around 30%, but it is the best case. I will assume 28%. In terms of P, definitely one of the best companies out there. At least a 20p above average for the S&P 500. Right now, the S&P 500 is trading at a P of 21. So Google, it's definitely better than average, better than the average company in the S&P 500. So I assume 22p. So with that, we have all done for our valuation and assessment. You could look into our dashboard with all the results. Now we are going to dive into what these 18 fundamentals actually mean and how to read them. If you want to use this exact Moneyjourney Stock Analyzer to save yourself hours of research, I'm doing a massive launch week discount. For $12, you can plug in your own stocks and follow along with me for the rest of the video. It's a massive discount to celebrate the community before it goes up to $27. If you guys are interested, the link is in the pinned comment. Looking at our Moneyjourney Stock Analyzer template, we have done all of our assumptions. We see Google stock price $385, but our fair value, intrinsic value, it's $286, which means a margin of safety that is negative because the price is above our intrinsic value. So it's basically slightly overvalued. It is one of the best companies out there. Our quality score developed by us shows that it's a 90.8 out of 100 score. With this assumption, we expect a 6.8% compound annual growth rate in the share price. And with that, overall, we came with a Moneyjourney score of 26.5, which means it is a hold for us. So it is not a buy. We don't get very interesting in buying company at this price because based on our assumption, it's not very attractive right now, but it's not definitely sell. Even though it's slightly overvalued, this does not mean that we should sell the company. So let's look at all of this template gives to us. In terms of fundamentals, we see a forward P of 26, forward earnings is of 3.8%. In terms of price free cash flow, it is a free cash flow yield of 1.4%. We can see margins, balance sheet, cash and long-term debt, return on equity and return on invested capital, and capital return, for example. When you look to the visuals, we see revenue, net income, free cash flow along past and the estimates for the next 2 years. You could see revenues actually accelerating their growth due to AI in the next few years. So analysts are expecting their revenues to grow like 15% per year. We see net income and free cash flow per share trending high, which is a good sign and something that we always look in a company. Bear in mind, free cash flow per share, it's basically what the company produces, and in a long time horizon, a company will grow or the stock price will go higher if their free cash flow per share goes higher as well. So we like to see margins going up, gross margins improving, net income margin improving by a lot, but very inflated by their investment in Anthropic and SpaceX, for example. That profits from that investment came as net income, but that's not operational profits, but it inflates their margins. On the other side, free cash flow margins are going down because of heavy capex investment. I'm not worried about that because they are investing for their for growth and for the future and doing very well. So as long as this investment yields good results, I'm good with it. Shares outstanding going down, which is always what we want to see. So as owners, we'll own a bigger part of the pie if the shares outstanding goes down, and this helps net income per share and free cash flow per share going up as well. And return on invested capital trending lower. We prefer to see a company where return on invested capital tends higher, but it's not by much, still above 30%, which is very good. We have done our quality scorecard, Moneyjourney checklist. It's 18 points that we always love to see in a company. We analyze revenue growth, past revenue growth, market potential, basically earnings per share growth in the next few years, what analysts are expecting. What is the quality of their revenues? Are they recurring? Are they cyclical? We prefer companies that on a subscription model where revenues are very recurring. It's not the case for Google, but it is better companies to see like that. We evaluate their product and process development, R&D investment if they are effective, margins, gross margin, profit margin, if they are maintaining their profit margins, how are their margins versus competition, do they have pricing power? That's very important. We love to buy companies that have plenty of pricing power because in the future that will increase profits, and that's what we want to see as shareholders and investors. How is their debt? Is their balance sheet very secure? How are the rates of return? Because if you see a company, for example, Google investing a lot in AI, you want to see high returns on the investment too, because if they are investing, you want higher returns. How is the management? How is the culture and reputation of the company? Do they have a moat and competitive advantage? How wide is that moat? What is the moat trend? Is this moat widening, enduring, or going, or for example, we see deteriorating? There are companies that usually, in the past, they had wide moats and now they basically have no moat. For example, now we see software that used to be a wide moat company, but with AI, their barriers to enter are actually getting lower, so their moat is deteriorating. Is free cash flow per share growth? Are they increasing their free cash flow? Because in the future, if the company increase or their free cash flow per share is growing, the stock price will go that will go higher. So that's basically the value of the company and a metric that we like to follow. Are they returning capital to the shareholder? Are they doing dividends and buyback? That's something we like to see. So that's some question. Then we do our valuation analysis where we put our assumptions. We even consider stock-based compensation. That is a real expense and most investor analysts miss. How is the risk of this company low? It is a West company. With that, we came with a discount rate of 12.8%. So it is our base case. To invest in Google, we believe we need at least 12.8% returns. So we do our assumptions in terms of revenue growth, what will be the free cash flow margins 7 years from now, and what is the PE that this company deserves in 7 years. With all of that, we come with an intrinsic value, a fair value of $285 for Google. So this is what our template gives us. We have a sensitivity analysis, for example, for the price that we have, $385, for example. If you assume a 10% discount rate, you are basically assuming a P of 26 in the future. If you want to look into what will be the revenue growth and free cash flow margin in the future, for example, the $385 price are assuming 32% margins, free cash flow margins, and 15% revenue growth. Or, for example, if they are assuming higher margins, 12% growth or 36% margins. On the other side, 17% revenue growth and 30% margin. So this is what the price at the moment, $385 are assumed. So this sensitivity analysis is something that is very helpful for us investors to see what the price at the moment means for investors, what they are assuming, what will be the growth prospect, future margin for this company. At the end of the day, successful investing isn't about guessing or following market hype. It's about letting the raw data dictate your decisions. The numbers simply don't lie. Now, I want to hear from you. After seeing the fundamentals we ran today, what is your true fair value for this stock? Do you agree with the system's output? Let me know your thesis down in the comments below. If you enjoyed this deep dive, hit that like button, make sure you are subscribed so you don't miss the next analysis, and as always, trust the numbers. I'll see you in the next one.